stock, crypto, credit moves. Good morning, YouTube. April 27th, 2022, 9 a.m. So in this video, I'm going to discuss, we're going to stay on the topic of credit, and we're going to talk about FICO 10 and FICO 10T and how it actually changed the credit game. Prior to 2020, it was a lot easier to fix your credit, because what was going on prior, you could add some authorized user trade lines, and you can take the derogatory marks off of your credit profile, and you can go straight into qualifying for things like even the lenders, they were using like FICO 8, they were using older models that didn't track your most recent history. So prior to FICO 10, you could just clean your credit up and then go straight into funding. You add a few authorized users, and at that time, those scoring models were not advanced enough to make very educated decisions on credit lending criteria. So it used to be easy to fix credit. You can actually fix credit in like a month or two. If you had negatives, you can get your profile cleaned and you can go straight into funding. Well, after June of 2020, that all changed, because now they came out with FICO 10, which has already been out for a few years, and I actually see it affecting clients now. So the FICO 10 and the FICO 10T, it changed the game, because now what they'll do is they'll go back 24 months and look at your history to see how you've been paying your bills over a longer period of time. And it just changed the way the industry actually lends money now. So that they've made it harder for people that are trying to get mortgages or cars that haven't been responsible with their credit over a 2-year period. And that's pretty much what the FICO 10 and the FICO 10T does. FICO 10T is FICO 10 trending. So they'll take a snap picture of your 24-month payment history. So let's say, like, if you haven't been making payments on time, it's going to affect you when it comes to qualifying for loans. That's pretty much the change. So let's go into this article. FICO's newest model put more weight on changes in debt levels, including trended data over a 24-month period. So a lot of people, they might have a good payment history over 3 or 4 months, but pretty much what the lenders are doing now, they'll go back and they'll use 2 years worth of history, and they can work in your benefit or it works against you. So a lot of people get stuck because in the last 6 months, their credit score may be showing at its highest, but when they take a look back 2 years, you recently fixed your credit or you recently improved your credit, and they'll deny you loans just based on the fact that in the last 2 years, you haven't really paid your bills on time. So really, it's to the point now where you need to make payments on consistent basis for a couple of years now to go into getting certain loans now. So the FICO credit scoring model, 30% is on what makes up the model. 30% is amount owed, credit card utilization. Still 35% payment history, 10% credit mix, 15% length of credit history, and then 10% is new credit. FICO's newest credit scores, the FICO 10 and FICO 10T, made a big splash where they introduced what they introduced in 2020, primarily because of 10T's versions, which looks back over 24 months of credit activity to predict future credit behavior. For vast majority of people, however, any changes to scores for the new credit model is likely to amount of 20 points less. So by them adding changes to the FICO, it dropped the average credit score by 20 points because they're looking over a 24-month period. FICO updates its scoring models about every 5 years. So the lenders have already implemented FICO 10 and FICO 10T. That's why now you need older history. Even if you're adding authorized user trade lines now, to get a boost, you need to have history, a lot more history now. FICO 10 scores are now available for use for all 3 major credit bureaus. Adopted by lenders will take time. It can take months or even longer for larger lenders. Right now, most lenders use FICO 8, which was introduced in 2009. And that model did not require them. That model wasn't designed to go back in history. So your current history was good enough. 3 to 6 months worth of payment history might have been good enough to qualify for a loan, not 24 months. How might FICO 10 affect your score? Your score is most likely to drop when using FICO 10 scoring model. It'll drop if you haven't been paying your bills over a 2-year period. But actually, if you're actually been practicing discipline all along, it should help you. You're using credit cards to get by, or you can't seem to wither the balances down, or your balances keep growing. You've missed a payment. The penalty for a 30-day past due will even be harsher than it was previously under FICO scoring model. So they're just trying to find different ways to weed people out for qualifying for loans. That's pretty much what this is all about. But if you're responsible and you pay your bills on time, this shouldn't affect you too much. But it's affecting a lot of people because they're not used to making payments over a long period of time. Keys to a higher score on FICO 10 and T. Pay down balances on credit cards. Consistently high statement balances or rising balance can suggest financial difficulty. If you're paying off your bills monthly but have high statement balances, make frequent payments throughout the month. That keeps your balance low no matter when it reports to each bureau. And I see that actually affects a lot of clients. So let's say, like, at the statement date of it on every credit card, let's say if you got a statement date on a credit card, that's the first of every month. What people will do, they're actually making their payments on time and they're paying them off, but it's never reporting because they're paying it too close to the statement date. So if you want your credit to report in a higher standing, if the statement date, which is when each bureau actually gets the information from the credit cards every month, you want to pay that off like a week before the statement date. So if the statement date is the first, maybe you want to make your payments to lower it down to 7% or less before the 27th of each month, or like a week before, 25th. So it gives it a week to update. So you're always showing that you're paying your cards down. For some people, they'll pay it like on the 29th, and every month it's still reporting as if they haven't made a payment at all because they're not giving it enough time to actually update. How to look good no matter what score lenders use. Pay bills on time. It's all about paying the bills on time. Keep credit card balances low relative to your credit limits. So if you got a $10,000 credit card, you should want to go for 7% or less with it reporting every month. So you should have $700 or less on a $10,000 credit card reporting every month. That way, it will keep your credit score at its highest, and credit card utilization won't get used against you. Be judicious about applying for new credit. A flurry of new applications can suggest financial distress. So a lot of times, they'll go to one car lot, then they go to another one, and you racking up all these inquiries. That makes you look credit thirsty. So they're looking at you like you need money, and it's actually used against you. Keep old credit card accounts open unless you have a compelling reason to close them. That happens to a lot of people as well, and it actually happened to me. So if you have a lot of credit cards, it's very easy to forget about a card. And I had one of my Capital One cards closed like that. It was like 10 years old, and it had like a $5,000 limit, and I just forgot about using it. So after a while, they'll actually close it. That's why sometimes it's good to leave a balance on each credit card. And maybe there's nothing wrong with leaving like $15 or $20 on each card to make sure you're keeping the card open, because after a period of a year with non-usage, they'll actually close that card. And another thing too, after like 2 or 3 cycles, when there's no balance on those cards, it'll stop reporting to the credit bureaus, so that trade line is no longer active. So it's okay sometimes to leave a small amount on a card just to keep the card open. That's just my opinion though. And we're gonna wrap this video up. I don't want to make them too long, but that pretty much covers FICO 10 and FICO 10T. So you are aware of why your score is not increasing as much as it probably normally would, is because of these 2 new scoring models. They actually been out a few years. It's actually getting to the point where it's getting implemented by a lot of companies, especially through the coronavirus. They definitely want to see that you're able to make your payments over a longer period of time. This information was just an illustration. I'm not your financial advisor. Anything I said today is just for illustration purposes only. If you like this, comment, share, subscribe. Until next time, signing off.